Good morning, it's Jeffrey Christian. It's 8:30 in the morning on Friday, the 14th of July here in New York. I wanted to talk about gold, silver, inflation, and interest rates. CPM Group has always said that on a short-term basis, the way in which financial markets interpret information or a particular piece of data is more important on a short-term basis than is the actual information or data. On a long-term basis, the reality matters more than what is often misplaced judgments by the financial markets in general. But on a short-term basis, it's the way the markets view a piece of data that matters. We saw that in spades this week because inflation data came out, CPI on Wednesday, PPI on Thursday. And when the CPI came out on Wednesday, you can see here, a headline inflation fell dramatically from 4% to 3%. And a lot of that had to do with petroleum products, gasoline and heating oil coming down. If you took that out, you saw a less sanguine inflation view for June. And that you can see in the maroon line here, which is all items less the food and energy components, which are more volatile than other components. So you saw food prices come off somewhat. The rate of increase declined, but energy prices, specifically petroleum products, continued to decline in June. That may reverse with the higher prices that we're seeing this week in petroleum prices, but that reversal may not appear until August, really. So you saw the CPI come off, and, this is the way the market likes to look at it year over year. We tend to look at it on a month-to-month basis because that tells you more about what's really happening now, or in June. And there you saw 0.2%, which is a pretty good figure. So inflation is coming off more rapidly than a lot of people had expected, including CPM Group. And you would think that in an environment where inflation, let's stay with inflation a little bit longer. These are headline and core CPI figures through June, and this is a CPI chart, so CPM chart. So we took it back to 2010, so you can get a history. The BLS looks at it on a rolling 12-month basis. And that's great, for a short-term view. But we like to think of things in a larger historical context. And here you can see how both core and headline inflation were relatively flat for a long period of time, actually going back to 1983, 84. But you could see relatively low inflation and 0% a couple times in the headline inflation, but core inflation running around 2%. It spiked higher in 2021 when we were coming out of the global pandemic and lockdown. Some people said it was transitional, and that inflationary period where we saw inflation get up to 8 and 9%. 6.5% in terms of the core inflation, but when you throw in oil and food, 9%. A lot of people, including CPM Group, were saying that was a transitory thing, and that while there were some structural inflationary pressures, there are also some very long-term structural deflationary and disinflationary pressures, and that this would be transitory. There were other people, gold promoters and hucksters, for want of a better word. Let's be nice and call them hucksters instead of something else. And they were talking that this was the beginning of hyperinflation. And you can see here now that inflation rates are normalizing. They might not get back to 2% on an ongoing basis right away, but you can see that the transitory nature of that higher inflation period was real. And then the key kicker, gold versus inflation. So we've seen inflation coming off over the last 12, 15 months. And we saw gold prices rise and stay high. And this week, when inflation came out, gold prices and silver prices rose sharply on Wednesday. Now, that is counterintuitive to those people who think that inflation gold and silver are good inflation hedges and that they move tick for tick with inflation. We've always pointed out that gold and silver are good inflation hedges in the long run, especially against higher inflation as they were in the 70s, but they're not particularly good against that gnawing 1%, 2% inflation that we've seen for most of the last 40 years. And they don't move tick for tick. The correlation in monthly changes in inflation and monthly changes in gold prices since 1968 is 9%. 91% of the time, the correlation's not there. So some people were surprised. Now, what was happening was interest rates. With the lower interest rates, there was a spasm of hope. Not necessarily thinking, but hope that in the financial markets that the Fed might slow its interest rate increases. The Fed has indicated a high probability that it will raise interest rates another 25 basis points when it meets in 26th, 27th of July. And in fact, the market consensus, the Fed tracker, Fed Watch on the CME is 95%, I think it is, still. I have notes. It's not that I'm looking to my master the way some of the hucksters would like you to believe. I have notes because I have a lot of ground I want to cover. It's about 95% of the financial market is betting that there'll be another 25 basis point increase in July. We're seeing lower inflation. We're seeing success in bringing inflation under control. Inflation, of course, is driven by a lot of factors. And as we've said repeatedly, ad nauseum, inflation is caused more by fiscal policies, which are dreadful right now, and real economic activity on both the supply of goods and services and the demand for goods and services than it is for monetary policy. But monetary policy is obviously important in controlling inflation. It's one of the major factors, along with fiscal policy, real economy developments, and the supply of goods and services and the demand for goods and services. So you're seeing the market sort of spastically say, the Fed might not raise interest rates. Pray to the gods that the Fed won't raise interest rates. And that's what caused the gold and silver prices to spike. Now, that's important because 26th, 27th of July come around in 2 weeks, and some of those people may be disappointed. Probably they're going to lose their faith in a cut in the interest rates between now and then because there'll be other economic data that will be released. The jobs reports will come out today, right about the time I'm recording this. And they probably will realize that the Fed has been doing a pretty good job understanding the state of the economy compared to, say, them. So that's where we are. This chart shows you nominal T-bill rates in brown. They've risen sharply from basically 0% to about 5% now. And the purple thing is the inflation-adjusted interest rate, which has been negative for most of the time since 2002. There were a couple spikes higher in 2006, 2007 into positive territory, but we've had negative real interest rates. Inflation has been higher than the interest rate for much of the last 20 years. And right now, with 3% core headline inflation and 5% T-bills, or 4.9, you actually have a little bit of a positive real rate. It's not enough to cause investors to say en masse, oh, wow, I can lock in 1% on a treasury for a year or for 90 days. So I'm going to get out of gold and silver and stocks and corporate bonds. But there is that there. Now, if we think that inflation is going to continue to decline, and if we think that by the time you get into 2024, 2025, you might see a recession, we would expect interest rates to start to decline as well. So it's not clear if you're going to see real positive real interest rates or negative. But what is clear is that probably they're going to stay low. And historically, it takes 3% or higher real interest rates for investors to say, I don't need to have so much gold and silver in my portfolio. So 3% real interest rates with 3% inflation is 6% interest rates, and there's very few people projecting that high. But that would be the base of the trigger. So our expectation is that real interest rates could go negative again, stay negative. 1 month does not make a trend. Or they could be positive, but at low levels. Low enough not to really cause investors to say, I don't think I should be holding so much gold and silver. That's the necessary view. So where do we go now? I'm going to put my glasses on so I can read my notes a little bit more clearly. We're seeing a stronger economy than the market had expected. Interest rates have risen sharply. They're appearing to be near the top, but not at the top yet. And so I think the end of July, early August is going to be important for a variety of reasons. One is the FOMC. Another thing has to do with the August Comex gold roll into December, which I'll talk about in a second. The market consensus, it is 95% right now on the CME, is that the Fed will raise interest rates another 25 basis points at the end of July and then hold them steady into 2024. And that's basically CPM Group's view. Interest rate increases have hurt some sectors of the economy, but let's be honest, look at employment, look at a variety of other sectors. We're actually seeing the economy not having been plunged into a deep recession or a depression the way the gold and silver hucksters have been saying that it would ever since the Fed started raising interest rates a year and a half ago. Inflation is coming down faster than a lot of people thought, faster than CPM Group had expected, but there are pockets of longer-term secular inflationary pressures to watch out for. So what does that all mean for gold and silver? Well, gold is 1,963 about as I speak. Silver is testing $25. Platinum's around $982, and palladium's around $1275 right now. Our expectation is that the prices will continue to move in their recent range. You can see here gold has been sort of in this range above 1,900 for the rest of July. There is some downside pressure. There is the potential for spikes higher, similar to what we saw on Wednesday. We don't think that Wednesday necessarily represented a breakout into the higher prices, but we do think that it demonstrated the fact that no investor is willing. The consensus of the investment market is not that we're out of the woods. It's just that we're in a clearing and we can exhale a little bit before we go plunge ourselves back into the deeper parts of the woods. You can see here that even at $1,963, gold is basically at record highs. It reached a record in 2020. It shot up, having spent a lot of time around $1,250, $1,350 into June of 2019. It started rising in July of 2019, and then it rose further in 2020 during the pandemic and the lockdown. Then it rose again when Russia invaded Ukraine, and it rose again in March of this year to intraday highs. On a quarterly and annual average basis, we're probably going to see record prices this year. Gold prices are not low. They're pretty much at record highs. Silver prices are not at record highs, but they're pretty high. And they're high enough that most producers should be able to make money producing silver. We do see this there. There are possible periods where the price could spike higher. Obviously, the Fed, if it doesn't raise rates on 27th of July, that could lead to a spike higher in gold and silver prices. Also, you do have the roll of the August Comex futures contracts into the December. Now, there's about 30 million ounces of futures contracts that need in the August contract outstanding as of the close of business yesterday. Those will be bought back by the shorts and sold forward in the December market, the vast majority of them. Most of that is not delivered. People who are involved in the futures market aren't necessarily looking for delivery. So there's no scare that you're going to bankrupt the gold market on the gold futures contract on Comex, or at least there ought not to be scare. If there's a scare, I would see a psychologist if you worry about that, or maybe a basic educator or an economics professor. 30 million ounces right now. 2 weeks before that becomes deliverable, actually a little over 2 weeks, it becomes deliverable on Monday, the 31st of July. That could put some upward pressure on a short-term basis in the gold prices. But once that roll is over or behind the market or largely resolved, that pressure comes off and the gold price could come off in August into September. There are downside risks, stronger economic activity, and gosh knows what could happen elsewhere. And we do expect prices to be higher later. We will be launching our 2023 Platinum Group Metals Yearbook on Tuesday, the 25th of July. There's an online briefing that's free. Go to info@cpmgroup.com and you can or go to our website at www.cpmgroup.com and you can sign up to participate in that online briefing for free. And you can pre-order the book if you want and get the book in the ebook form that day. After the 25th, I fly down to Boca Raton to speak at the World Symposium on Natural Resources. They had asked me to speak on the world is not ending, but the good news is you can still make money on gold and silver. I changed the title yesterday because we came up with some very interesting research we've been doing that's jumped over a couple hurdles and related to rare earth element magnets that people say you need vast amounts of rare earth metals for magnets for electric vehicles. And there's some very interesting research in substitutes for REE metal magnets in motors. And there are several major auto companies and EV manufacturers that are moving as rapidly as they can away from those. And that has implications not only for rare earth element investments, but it also has implications for copper, because a motor made with this other material, which consists of two of the most common and cheapest elements on Earth, magnets and motors made with this alternative magnet can be half the size of rare earth element magnet and motor. That has big implications for the weight in an electric vehicle and weight distribution and the size of the motor you need. And it also probably has very big implications for the amount of copper you're going to need, not only in motors for electric vehicles, but for motors in general. The average house in America has more than 30 motors in it. And you may be able to cut the size of those motors in half and the amount of copper needed in those motors in half over the next decade or so as you roll out the next generation of magnets and motors. I'll be talking about that as well as the world's not ending. Gold and silver are still good investments in which you can make money. And, a cautionary tale about copper and rare earth elements. So that's speaking on the 27th of July. I'll be in New York on the 25th for the PGM yearbook launch. So I will miss 24, 25, and 26 at the Rule Conference. So I won't hear all of the things that people are going to be saying about how the world is in fact going to end, and we are going to have a gold-backed currency which will replace the dollar and everything else, and gold is going to $40,000, and you should invest in rare earth and copper mines because the world isn't going to have enough of those. I'm going to miss all of that, But I'll give you my opinion at the Rule Conference on the 27th. You can go to our website and read all sorts of stuff about us. I'll see you next week. Have a good weekend. Take care of yourself, those around you, your whole community, and your community consists and includes the world.